Have you ever wondered where to put your hard-earned money first to truly build wealth and achieve financial freedom? Navigating the maze of high-yield savings accounts, employer 401ks, Roth IRAs, and individual brokerage accounts can feel overwhelming, especially when the advice out there seems to conflict. Today, we are breaking down the exact step-by-step hierarchy of investing that experts use to maximize returns and minimize risk. Whether you are a beginner just starting to build an emergency fund, an intermediate investor looking to optimize your tax advantages, or an advanced portfolio manager seeking to diversify into index funds and real estate, this video will provide you with a definitive roadmap to structure your capital. Stick around because by the end of this video, you will know exactly how to prioritize your dollars so that your money starts working harder for you, ensuring your path to financial independence is both secure and highly efficient. Part 1. Building an emergency fund for baseline security. Creating a solid financial foundation starts long before you pick your first stock or mutual fund, and it requires establishing a robust emergency fund. An emergency fund acts as your primary layer of defense against unexpected financial shocks, ensuring that you do not have to sell off your long-term investments or rely on high-interest debt when life throws an unpredictable curveball your way. The standard recommendation is to hold 3 to 6 months of essential living expenses in a highly liquid and secure account, such as a high-yield savings account or a money market fund. By keeping these funds separate from your daily checking account, you reduce the temptation to spend the money while earning a small amount of interest to slightly offset the impacts of inflation, maintaining the purchasing power of your safety net. To accurately determine the size of your emergency fund, you need to calculate your true baseline monthly expenses by separating your needs from your discretionary wants. List out essential costs like housing, utilities, groceries, insurance, and minimum debt payments, ignoring entertainment or dining out for this specific calculation. If your employment is highly variable, or if you work in a volatile industry, aiming for the higher end of the 6-month spectrum, or even expanding to 9 or 12 months, provides an extra layer of psychological and financial comfort. Knowing exactly what your baseline security number is allows you to operate without the fear of immediate financial ruin, which ultimately enables you to make clearer, more rational decisions when you begin allocating capital toward riskier investment vehicles later in your wealth-building journey. Building this fund does not require a large lump sum up front, but rather a consistent, automated approach that aligns with your income schedule. You can start by setting up an automatic transfer from your primary checking account to your designated savings account on the day you get paid, treating your emergency fund contribution like a non-negotiable monthly bill. As your income grows or your expenses increase due to major life changes, such as buying a home or having a family, you should periodically recalculate your targets and adjust your contributions accordingly. Achieving this baseline security not only protects your current assets, but also creates the necessary psychological runway to take calculated risks in the market without panicking during normal economic downturns. Part 2. Taking advantage of employer-sponsored 401k matches. Once your emergency fund is securely in place, the very next step in your financial hierarchy is capturing the full employer match offered in your 401k or similar workplace retirement plan. An employer match is essentially free money, providing a 100% immediate return on the portion of your contribution that the company matches up to a certain percentage of your salary. For instance, if an employer offers to match dollar for dollar up to 5% of your salary, and you contribute that amount, your total contribution effectively doubles before accounting for the growth of the underlying investments. Leaving this match on the table is equivalent to turning down a portion of your compensation, which is why it is prioritized immediately after building your emergency reserve. To fully take advantage of this benefit, you must first understand the vesting schedule associated with the employer match, which dictates when the money officially becomes yours to keep. Some companies offer an immediate vesting policy, meaning every dollar matched is yours from day one, while others require you to work for the company for a specific number of years before the employer contributions are fully yours. It is important to review your human resources manual or plan documents to understand these timelines, as leaving a job before you are fully vested could result in forfeiting the matched funds. Additionally, you should ensure that your contributions are actually directed into diversified investment options, such as low-cost index funds or target date funds, rather than simply sitting in cash inside the 401k account, which would otherwise fail to beat inflation over the long term. Maximizing the employer match goes beyond simply contributing enough to get the free money, as it also involves understanding the tax advantages inherent in a traditional 401k. By contributing with pre-tax dollars, you reduce your overall taxable income for the year, which lowers the amount of tax you owe while allowing more capital to compound over time. Even if the maximum legal contribution limit for the year is quite high and you cannot reach it immediately, your primary objective should always be to cross the threshold required to get the absolute maximum match your employer offers. Once that specific percentage is secured, you can then evaluate whether further contributions should remain in the 401k or if your investment dollars would be more strategically utilized in other accounts, such as an individual retirement account, which often provides a wider array of investment choices and lower fees compared to typical employer-sponsored plans. Part 3. Maximizing tax-advantaged accounts like Roth IRAs. After securing your employer match in your workplace retirement plan, the next logical step in the hierarchy of investing is to direct your additional capital toward an individual retirement account, specifically a Roth IRA. A Roth IRA is an exceptional wealth-building tool because it allows your money to grow completely tax-free and enables you to withdraw the earnings without paying taxes when you retire. You contribute after-tax dollars, meaning you do not get a tax deduction in the year you make the contribution, but you lock in the ability to enjoy future tax-free growth. This structure is particularly advantageous for individuals who expect their tax bracket to be higher in the future, as well as for younger investors who have decades of compounding ahead of them. To make the most of this account, you must be aware of the contribution limits and income thresholds set by the Internal Revenue Service, which can vary from year to year. For those whose income exceeds the phase-out limits, advanced strategies, such as the backdoor Roth IRA, allow you to convert traditional non-deductible IRA contributions into a Roth IRA, ensuring that you can still participate in these tax advantages regardless of how much you earn. Once the money is inside the account, it is up to you to select the underlying investments, which means you can choose between low-cost index funds, exchange-traded funds, or even individual stocks that match your specific risk tolerance and financial goals. Choosing the right brokerage for your Roth IRA is a crucial operational step, as you want to minimize fees and maximize the selection of commission-free investment options available. Platforms such as Fidelity, Charles Schwab, and Vanguard offer robust interfaces with zero-fee index funds that allow you to invest small amounts of money without being penalized by transaction costs. By automating your monthly transfers into this account and ensuring that the cash is immediately invested rather than sitting idle, you turn the compounding effect into an automatic wealth generation engine that protects your returns from future tax liabilities. Part 4. Scaling up with index funds and ETFs. Once you have established your tax-advantaged accounts and reached your baseline savings goals, the next major step in your hierarchy is scaling up your portfolio by investing in index funds and exchange-traded funds, also known as ETFs. These investment vehicles pool together money from thousands of investors to to purchase a diversified basket of stocks, bonds, or other assets, giving you instant diversification across hundreds of companies without the need to analyze individual businesses. By holding a broad market index fund or a total market exchange-traded fund, you effectively own a small piece of the strongest publicly traded companies in the United States and globally. This approach eliminates the concentration risk that comes from picking one or two winning stocks and instead aligns your returns with the broad growth of the entire economy over the long term. When navigating these options, you will find that exchange-traded funds trade throughout the day like regular stocks, whereas index mutual funds are priced only once at the end of the trading day. For most long-term investors, exchange-traded funds offer greater flexibility, lower expense ratios, and higher tax efficiency, which means more of your hard-earned dollars stay working inside your account. Choosing funds with an extremely low expense ratio, often below 0.1%, prevents fees from slowly eroding your compounding returns over a period of 10 or 20 years. Platforms provide access to commission-free trading on major index funds like the Vanguard Total Stock Market ETF or the SPDR S&P 500 ETF, allowing you to build wealth with minimal friction. Implementing this scaling strategy effectively requires a disciplined dollar-cost averaging approach where you consistently invest a fixed amount of money every month regardless of market fluctuations. By purchasing shares on a regular schedule, you buy more shares when prices are low and fewer shares when prices are high, lowering your average cost per share over time. This continuous allocation prevents the emotional trap of trying to time the market, which even advanced investors struggle to do successfully. As your account balance grows, you can rebalance your holdings periodically to ensure your mix of stock and bond exchange-traded funds continues to match your personal risk tolerance and time horizon, creating a steady and resilient compounding machine. Part 5. Diversifying into advanced assets like real estate and individual stocks. Once you have established your safety net, captured your employer matches, maxed out your tax-advantaged accounts, and built a solid base of index funds, you reach the final stage of the investment hierarchy, which involves diversifying into advanced assets. This stage is designed for intermediate and advanced investors who are ready to take on higher risk in pursuit of asymmetric returns or specialized income streams. Real estate and individual stock picking require a significant amount of research, capital, and active management compared to passive index investing, but they offer distinct advantages such as leverage, tax write-offs, and the potential to outperform the broader market averages. Allocating capital to these advanced areas only after the previous steps are secured ensures that any misstep in these riskier assets will not compromise your fundamental financial security. When it comes to real estate, you can gain exposure through various methods depending on your capital and desire for active management, ranging from physical rental properties to real estate investment trusts, also known as REITs. Physical real estate allows you to use bank leverage to buy assets, build equity through tenant rent, and take advantage of tax deductions like depreciation and mortgage interest, though it demands time for property maintenance and tenant management. Alternatively, if you prefer a hands-off approach, publicly traded real estate investment trusts allow you to invest in large-scale, income-producing real estate without the operational headaches of being a landlord. To evaluate these opportunities, investors analyze metrics such as capitalization rates, cash-on-cash returns, and location fundamentals to ensure the property generates positive cash flow after all expenses are paid. Adding individual stocks to your portfolio represents another advanced strategy that should only be pursued with money you are entirely willing to lose or see fluctuate wildly. This specific portion of your portfolio should generally represent a small percentage of your overall net worth, often kept under 10%, serving as a satellite portfolio to your core index fund holdings. To succeed here, You must move beyond passive index tracking and dive deep into fundamental analysis, which involves reading corporate financial statements, understanding the competitive advantage of a business, and analyzing price-to-earnings ratios. By focusing on high-quality companies with strong balance sheets and consistent revenue growth, you can generate superior returns, but you must remain completely disciplined and avoid emotional reactions to short-term market volatility. To sum it up, building wealth is not about taking wild, uncalculated risks all at once. It is a methodical, step-by-step process of protecting your baseline, capturing free money, and progressively scaling your investments for long-term growth. By following this exact hierarchy, from building a robust emergency fund to securing your employer 401k match, maxing out your Roth IRA, scaling with broad index funds, and finally diversifying into advanced assets like real estate, you are building an invincible financial roadmap. Remember that the smartest way to invest is the one that remains consistent, automated, and disciplined even when the market fluctuates. If you found this step-by-step guide valuable and want to continue leveling up your financial intelligence, please make sure to subscribe to the channel and turn on notifications so you never miss our upcoming investing tips. Also, let me know your biggest takeaway from today's video by leaving a comment below with the phrase, "Consistency is the key to wealth," and I will see you in the next video.